people keep saying, well, this narrative is coming back, which is tech or the Magnificent Seven is becoming larger and larger part of the indices, right? And is this another 2000? Welcome to the 8th episode of Curve Your Enthusiasm. We are your host, Howard Chan.
And Dominique Tersin.
This podcast is a discussion of everything relating to investing and everything adjacent to it. It is important to remind the listener that the trades we discuss on the shows are not meant to be financial advice. And we are recording this on September 2nd, 2025 at around 5:30 p.m. Eastern Standard Time. All right, Dom, it's been a while since we recorded one. Been busy. Market has been up to very interesting things. So maybe today we start with the market roundup. We just finished up the earnings season. Last Wednesday, NVIDIA reported earnings, which is the last, I would say, tech company to report earnings during this cycle. So let's talk about how the earnings seasons went about this quarter.
Yeah, well, I think I could qualify the second quarter earnings season as better than consensus, rather robust, and as usual, biased toward the tech sector. If we dig deeper, they were better than expected because, 4 out of 5 companies reported better than estimates. And that was even higher for the tech sector. They were robust because profit margins rose a little in general, still. They're high, going higher. And they were also moderately higher for the tech sector. Earning growth rose also from 5 to 12% on an annualized basis for the last quarter. So that's pretty good. If we look at the details, something could be interesting is one would have thought that tariffs will be a positive for the traditional sectors, the US companies, the US-centric companies. But the data show that the more global the companies, the higher the earning growth. That said, it could be still too early to tell because we have the weaker dollar. So that will favor the exporting companies. How about the consensus expectation for futures earnings? Well, same thing, even higher earnings as expected. The guidance for the year have been raised for more than half of the companies, and for the tech, it's 90% of the company rose their guidance. What we could hear for the earning calls is the word recession. It dropped from a fifth of the call during the last quarter to almost nothing this quarter. So they are pretty optimistic on earnings for the year. And what we could say, what about pricing? Market rose quite a bit even before the earnings. So there might be some expectation already priced. And what we have is trailing P for the S&P. I see it as around 27. And the average is around 23. So we're on the high side, and it's the same if you look at forward PE. It's still on the high side. That said, if you take the analysts, the average of the analysts' targets for the S&P, the bottom line, you take each company targets and you add the 500 of them. It says a 13% rise, still for the targets. So pretty good.
I thought it was a blockbuster earnings season. I think everybody going into this earnings season was trying to figure out if tariffs had an effect on these companies. And I think there was a lot of uncertainty into the market. And for the most part, and it made sense, I think maybe after the fact, and we've talked about it before, is that most of the tariffs haven't really been in effect. So most of these companies really haven't had to deal with tariffs yet. And I would say that this earnings season, we've seen really the affirmation that AI infrastructure and a lot of tech companies continue to do really well for a few different reasons. There's been an exemption on chips for tech companies. Most tech companies are services companies, so even if there are very little tariff effects, and even if it do, they'll filter in much, much later than durable goods company. And lastly, I think most folks are now expecting tariffs effect to come in, right? So, from that perspective, you see that, most of the tech companies have done extremely well. The outstanding, I would say, company that reported was Microsoft, in which we saw both cloud and Azure and just hit it out of the park. NVIDIA had pretty good earnings. I mean, the earnings, if you look at the graph, it just keeps going up. But even that really wasn't enough for the market. So the stock receded a little bit after earnings. But Google and lots of other tech companies in that sphere, where again, for first-time listeners, we have checked the podcast from the beginning of the year, said that we continue to be very constructive in the AI infrastructure companies. So that includes cloud computing as well as the chip makers, cloud computing from Google, from Microsoft, from Amazon, AWS, and then the chip companies such as NVIDIA, of course, Broadcom, all of these folks who create the chips, that ecosystem will continue to do well. And we saw that was reaffirmed during this earnings season, that earnings continue to climb up. And in fact, it's almost seemed that we have erased the scare from DeepSeek, and most of these companies have climbed back to all-time highs or close to all-time highs, if not higher than all-time highs. So that growth trajectory continues. And I think the one thing to mention is that if you take a look at the total return, the contributors of returns for this quarter, it's actually been driven by mostly the tech companies, the Magnificent Seven companies. So it is, I think, turning out the thesis that we had, which is that tariffs are not in effect yet. We'll talk about what we think is coming down the road for the US economy and other companies, but also that the demand for AI infrastructure just way outstrips the supply. And so we've seen that demand continues to drive earnings for a lot of these companies.
I saw a chart, I think it was from BNP Paribas, on the US GDP, and the contribution to the private tech expenditure. And half of it for Q2 was, for the first half of the year, was coming from data center.
Yeah, and maybe let's just talk a little bit about that, right? A lot of these are, I would say, kind of incestuous, right? So a lot of the companies who are making large language models, so this would be OpenAI, this would be Llama from Meta, this would be Gemini from Google. They're trying to build these models. And in order to make these models success, they have to have compute. And compute requires two things, which are chips to train the large language models and data centers, the cloud providers, to be able to help them keep training these models. Now, some companies, this is incestuous because obviously Google, who's trying to make a better version of Gemini, also has a cloud computing, Google Cloud service, right? You have Microsoft that, in somewhat they are, OpenAI is the model that they use, but they're also now developing an internal model. They offer Azure as a computing service. And then, of course, that computation needs to be a data center that requires a lot of chips, of which NVIDIA, with both the H2O chips as well as the Snapdragon and the new type of chips, all of these companies are essentially paying their own services or paying the chip makers huge capital expenditures in order to build these LLM models. So I would say that it's sort of you're feeding your own company on these capital expenditures. And of course, that will generate growth because you need more folks and resources to produce the chip and to build up the data centers.
Yeah, no, it amazed me that how much of the working population is this sector, like 1%, 2%. It represented half the growth of personal expenditure. Okay.
Yeah, and I think that's actually related to our outlook a little bit, is that I actually has a view that much of the economic activity right now is being propped up by these capital expenditures from the AI companies. So one has to be a little bit cautious that if the demand were to shrink, right? And ultimately these capital expenditures will depreciate, and maybe if it just slightly stops, what's that implication on growth? That is something, a risk area to think about. So I think I would also say maybe let's dive into, now that we have finished earnings, how did asset markets and prices of different assets actually perform? I would just say, start by saying that we're recording this on September 2nd. It's been probably one of the worst days in a few months for risk assets. I think part of it is because some people are taking profits after the earnings seasons. And there are also some questions about, fiscal deficit. That story seems to be coming in. So risk assets and tech did not so well today. And one of the winners continues to be gold exposure. So maybe I'll turn that over to Dom and just kind of give a quick review of asset markets.
Yes, actually, all assets did pretty well. The only that didn't go well was the dollar. That went down, but not by much, just 1% against other currencies. Bonds, equities. So the 10-year Treasury was down 20 basis points. Fed Fund futures down 10 basis points, expecting a bit more cuts from the Fed, thanks to Powell on the last Jackson Hole meeting in August. And we had equities plus 6%, which is pretty nice in 3 months. And gold, exactly, 6% as well. You could think that as a safe haven, gold will be down when assets are up, but no. All the year, gold has been up when assets are down and when assets are up. There's a stronger behind it.
Yeah, but I think another thing to really note, especially today, right? Yield sold off actually during this risk-off environment, and gold continues to climb. This really continues the narrative that we have, which is that dollars and U.S. assets are not as favored now as like a safe haven asset as gold. And so when there is a market disturbance, instead of fleeing into treasuries because of fiscal considerations, the huge fiscal deficit that the U.S. government has, money is not going into U.S. treasuries and U.S. dollar assets. It's actually going into gold.
Yeah, exactly. And on the volatility front, well, it's kind of the same as 3 months ago and as beginning of the year. Kind of the normal range, to be honest.
I mean, it seems like basically since June, we just did a round trip on everything.
Yeah, if you look at the equities, it was a relentless rise from June to a bit soft patch beginning of August, and then continuing the rise, which was supported by earnings, right?
Yeah. I mean, earnings continue, and I think this is where a lot of commentaries go full circle, which is, people keep saying, well, this narrative is coming back, which is tech or the Magnificent Seven is becoming larger and larger part of the indices, right? And is this another 2000? And I think the one big difference is most of the tech companies in 2000 had no earnings. They're not profitable. These companies are actually generating earnings. And I would say that their balance sheet is much stronger than what the tech companies were in 2000. And the one thing I really want to focus on, because I think this narrative it's important, but I think it's wrong. Because people keep focusing on how big these tech companies are in the S&P 500. And I think that's like the wrong comparison, right? These tech companies are deriving revenue globally, not just in the US, right? These are companies that just happens to be American companies listed on an American exchange. If you really look at, I think the more appropriate index, the component index, is probably, say, NVIDIA in MSCI World or MSCI ACWI, which is a global equity index, right? NVIDIA is 5% of that index. it's deriving revenue globally. So while it's a large component, it's really not as overstated as everybody says it is. So I think that's something, I think it's in context of everything else, right? These are not just technically US companies. These are global companies that are deriving revenue everywhere.
They are driving revenue and revenue growth. The difference between the tech sector and the rest is still high.
Yeah. And if you said that there was maybe a competing set of companies, say in Europe or in Asia, then I would be a little bit more worried about concentration. But the concentration is because they're sucking up revenue from all over the world. But I would say risk markets has also really responded to not just what earnings has been doing, but rather actually a lot of economic news that's been coming up. And there has been a lot of, I guess, focus on both how the economy, mostly US, is doing, but also rest of the world is doing, and also what the Fed is going to be doing. Risk asset markets has not only been responding to earnings, but also a lot of economic news that's been coming out, and especially that tension between what's happening in the economy and what the Fed is going to be doing. So I think we should unpack some of the numbers that have been coming out. And I think let's focus on separate out broad economic activity and then maybe focus specifically on inflation on the second point. So, Adam, maybe let's go over some of those numbers.
So growth. What happened to growth? We had so the numbers came very recently for the Q2 GDP in the US, real GDP, and it went very good at 3.3%. That said, it has to be put in the context of Q1 data that was minus 0.3, I believe. And that's because of how you count import and export. So the trade deficit was negative in Q1 because everybody was front-running the tariffs, importing a lot. And since they have a lot of stock, they don't need to import that much. So the trade deficit decreased in Q2, and that's part of it in the real GDP numbers. That said, if you look at the more faster measure, the Atlanta Fed GDP now, it's a decent 2.2%. I mean, it's not 3%, but it's stable at 2.2%. So it's pretty good.
How are the sentiment surveys, sentiments from both business and consumers?
And that's where the hard data differs from the soft data that we call the sentiment surveys. Manufacturings were and non-manufacturing were lower. So we had numbers of around 50 and even below 50. 50 means above 50 you have growth and below you don't. So that's not very good. And the consumer sentiment was more stable, but stable on a low number. It's not ideal. So the question will be if the hard data will come down to the soft data in the next quarter.
I think obviously the focus that the market had, at least for the last month or two, is both on the subject of inflation and labor markets, and those two seem at points contradict each other, and then maybe agree with each other. Maybe let's talk about inflation first. Where is that at?
Yeah, I remember we did our, I think it was one of the first podcasts we did early in the year. We were talking about stagflation, so low growth with high inflation. Well, the inflation is on the last number we had in August. They're higher on all measures. CPI, core CPI, PCE, core PCE. and they were higher, but also higher than what the Fed would like to see, which is the 2%. So inflation came around, let's see, depending on the measure, from 2.6 to 3.1% on an annual basis, which is, to be honest, too high for the Fed, I would believe.
I mean, I think one of the concern is the last inflation print that just came out last week or the week before. We actually saw an uptick on inflation, mostly on the services sector, which is a little bit unexpected because you would have thought if there were any tariff effects that it would be on goods, not on services. What's your take on that?
Well, yeah, that's true. During earnings calls, some companies said that they were raising their prices for retail. So it might be slow to see it in the numbers, but probably in the next month, next quarter, that should keep the retail prices high or higher than it should be.
So my take on this is that, when you raise tariffs, there are really three parties who can take the price shock, right? The first is the exporter. The second is the party who's importing the goods. And the third party is the consumer. And I think up until now, a lot of the cost has been shared by the exporter and the importer because there was a lot of uncertainty about the level of tariffs. And we saw just starting about a month and a half and 2 months ago that a lot of the companies started to indicate that they're going to start seeing or pass some of the tariff increases to the consumer. We saw some announcements from Walmart. We definitely know the car companies have faced higher steel tariffs from steel prices from Canada. But a lot of the price increases isn't going to happen immediately, right? So I was listening to a report and they said, if you're a car maker, you're not all of a sudden going to increase the car prices for this year's model, but you might increase the prices of the model for next year because you would generally have a price increase anyways, and then you would include the increase in prices of steel into next year's model. So that inflation is coming but have not been experienced yet. So I think, some of the tariff effects hasn't really been felt, and it probably will start seeping through the economy slowly going towards the end of the year.
And it has been a while since we've seen in the sentiment survey the question about the price paid, and the manufacturing sector, it's still on the high. So they are still paying higher prices from what they produce. At some point, it's gonna feed through.
Yeah. And I think that probably is something that we need to continue to look at. But maybe then let's switch to the labor market updates because there's been a lot of, I guess, shocks in those particular numbers.
Yeah, the shock came from, two shocks. From the low number on the non-farm payroll in August at 73,000. Usually, to say growth, we would think about 150, 200. And the second shock was on the amount of revision that happened in the previous months. They were all lower. So that shocked the market. That said, we still have an unemployment number of pretty low and stable at 4.2%, and earnings from wages stable and even higher, which is higher than inflation. So conflicting signal. I think the market focused on the revision and the number of NFP to have some pessimism there.
Was trying to square these two things, downward revision of the number of jobs versus the unemployment rate is pretty stable, and actually real wages actually went up. So how can all of these things to be true? And I think the most credible explanation of this is actually, if you look at payroll numbers, those are absolute numbers, right? And unemployment rate, employment rate, those are percentages, right? Divided by the total amount of people who are in the workforce. So the way to make sense of this that I think is believable is that the denominator has been changing. So meaning that, of course, the market was really shocked that the revision for total payroll for the last 2 months have dropped dramatically. First of all, those surveys have revisions because usually the largest companies respond first, and as the smaller companies come in, they revise the number based upon those survey answers. They update and revise the numbers based upon the stragglers for the surveys. And I think, as most people know, that there's been a more focus in terms of immigration, or rather immigration crackdown, and people who may have not been in the country legally, a bit more afraid to get work. So that population of employable people may actually be shrinking. So if you think that the payroll has been marked down at the same time that the population of possible employed people has actually go down, that actually maintains the unemployment rate, the employment rate, all of those rates, right? And because the employment population is smaller, workers do have more bargaining, so real wages went up. So I think in that context, actually, it does make sense. Those numbers are not necessarily conflicting. It just means that actually the population who may be seeking employment may actually be changing. And it's very rare, but it's typically doesn't change too much because, population of employed people, or the people who are typically able to be employed, is relatively stable, but not in the current environment in the US because of immigration policies.
And what matters for the market is the absolute number. It's how many workers there is times how much they produce. So that's why probably the market went weaker during the announcement.
Yeah. And so, okay, so if we're in a situation in which inflation is still elevated, I would say it's been coming down other than the last print, but still elevated, and employment is fairly stable but revised downwards, then the question is whether we would have a rate cut. And I think at Jackson Hole, which happened about a week ago, there was a big question of whether the Fed would be open to a rate cut despite the high inflation level relative to their target. Of course, there's a lot of pressure from the administration to get the Fed to lower rates. And what we had was at Jackson Hole, with Powell opening the doors to a possible rate cut. Before the announcement, it was about priced at 92% probability for a rate cut. After the inflation print, it went down, and after the Jackson Hole announcement, it went back up again. So it seems like there's a high probability for 25 basis points rate cut in September. Do you agree with that? Do you think that's a good idea? Do you think the Fed is bowing to the pressures from the administration?
Yeah, so there is the Fed has two objectives, sometimes conflicting, like today. One, to keep growth high, or at least at a normal speed, and to keep inflation at a 2% level. Clearly, we are not at 2% level in inflation. There is probably positive trend for inflation still going, like, tariffs for one, probably wages still high, and the dollar going down. That's probably trending inflation. It seems like it seems that Powell switched to defend the growth and was afraid from the employment change. I will wait a little, but they probably won't. He has a lot of pressure, political pressure. There are some numbers, right, at the end of this week that may be crucial. Maybe a lot of volatility around this one.
Well, I mean, I think from being open to a 25 basis points rate cut with another inflation print and a couple of very important numbers coming out, I think probably the indication is we're going to have a 25 basis point cut, and that's been already priced into the market. So it's only if there's no rate cut, I don't think there's going to be a rate hike, that would probably upset the market. Don't think right now we're going to expect a 50 basis points rate cut. So it's either we get a 25 basis point rate cut or we're going to have nothing. And I think it seems like the market is pricing in for 25 basis points rate cut. I do think it's interesting that he opened the door to the rate cut before having all of the data. And it is also interesting that the last inflation print did actually go higher than expected. It seems like that there's a high probability, in my opinion, that we're going to get a 25 basis points rate cut in September.
Yeah, I mean, there is another argument for a rate cut is real rates, even on long term, they are pretty high, above 2%. Maybe you have room on that to decrease long-term real rates, but I'm not sure the effect will have to decrease the Fed fund on the long-term real rate. Not sure. They actually increased since Powell, right? 30-year yield increased since then.
Well, I mean, that kind of really dovetails really nicely about our outlook, right? We are at the beginning of September. We have about 4 months left of the year. So maybe more importantly, what we want to do now is to talk about what our forecast or outlook is for the remainder of the year. Let's go through all these CPIs and PCEs. They're backwards looking. So let's maybe take a look at what the market is expecting in terms of inflation. So if you look at on the chart right now, the orange and the green line are past core CPI and PCE numbers. These are the numbers that the Fed looks at. And the future market pricing of inflation can be seen from two aspects. One is the 10-year break even. So this is the yield on the 10-year treasury minus the 10-year tips. So that's what break even is, sort of the market expectation of inflation over the next 10 years. The other way to look at it, which is very common, is a 5-year. So that is what 5-year inflation is in 5 years. The reason why people look at that is that numbers tend to be more stable. And so maybe, Dom, right now, maybe you want to walk through us, where is the forward-looking inflation print is, and how do we feel about those levels?
Yeah, so the 10-year inflation break-even is about, and actually the 5-year, it's around the same, 2.3 to 2.4%. So the market expects, on average, for the next 10 years, the inflation to be about 2.4%. That was actually what the CPI was for the past 20 years. So in a way, the market doesn't expect an increase or decrease, just about the same. And it expects more than what the Fed wants.
So the market seems to believe that inflation will be maintained over the long term. But I think, at least for our outlook for the remainder of the year, our cyclical outlook, at least for the next 4 months, is that, at least for myself, some of the tariff effects are going to start feeding into the economy, and we're going to starting to see pockets of inflation in the economy, not a general rise. We're going to see, as I mentioned with the car example, inflation is going to start popping up, but in the cycle of those products. So we will see some pass through of these tariff effects into the economy, which I think will make the Fed's job harder. And so from a rates perspective, I think what we forecasted last December might still be on the point, which is that we're going to have maybe 1 or 2 rate cuts this year. There's only how many Fed meetings? There's September, and then there's
I think it's September, November, and December, I believe.
November and December. So there's only, if you count 25 basis points cut in September, I think it'd be we might be able to eke out another 25 basis points cut, but I think the Fed will have to be focused on both growth and inflation, unless what we will see is there's a weakness in the economy. And in that case, that's actually a very hard decision for the Fed to make. Right now, employment is pretty high. Full employment, I would say, in the economy, inflation is more or less maintained, so they can take that 25 basis point cut, maybe another one. But if the economy becomes weaker towards the end of the year, inflation also increases, they will have to have some hard choices to make.
Yeah, I just checked. It's not September, November, December. It's September, October, December. And on the inflation, to me, with a 7% deficit, public deficit, you have interest to have inflation.
Yeah, it would be biased on the upside, right? I mean, one of the things I think is a little bit of a mystery about, the higher yield on the longer end of the curve. I'm not sure. I think it could be concerns about inflation, but not inflation from the tariffs, but from the fiscal deficit, meaning depreciation of the currency. Because growth is still relatively strong, and if it becomes weaker, right, the rate should go down. So I think now there is sort of a depreciation premium that's in the long end of the yield curve.
Yeah. Well, the break-even don't change. They haven't changed much since like 3 months or something. Even for the past year, it's not that much different. If there is a real scare on that, I would think the break-even will go up, right? But they don't.
Yeah, so I think for us, we're being a little bit more cautious in our portfolios. We're focusing to be a little bit more defensive. I think we took off some of our hedges for earnings seasons because we believed that the earnings seasons was going to be pretty strong. And we're starting to put some of our hedges in terms of writing a bit more covered calls, buying a little bit more puts from our option strategies. And then in terms of portfolio positioning, we still like the AI infrastructure story, though a lot of that has played out. But what we're focused on is building a position in, again, consumer-focused technology exposure, which tends to be things like Netflix or Spotify, where probably that's the last place to cut in your budget. Although I would say the last consumer spending print was very, very healthy. People are still spending like there's no tomorrow. And then, of course, I think gold will still continue to be a very important asset in people's portfolio to anchor in case there are bad news about an economy that's going to shock the system, and see maybe moments where risk comes out of the market. That would be an important hedge in the portfolio. Well, that's it for this episode. If you enjoy this episode, please like and subscribe wherever you found this podcast. That really will help us out. And we'll see you in the next one.